What is happening, crypto fans, and welcome back to Bitcoin Bulletin, your ultimate source for the pulse-pounding news shaping the digital asset world. We've got a packed show today, with market movements that are turning heads and strategic plays that have everyone talking. The pace of innovation and investment is absolutely relentless, and if you're not plugged in, you're missing out on the biggest shifts happening right now. Get ready for insights that could redefine your understanding of the landscape. We're diving deep into major institutional plays, exploring critical market indicators, and uncovering how major corporations are navigating this dynamic space. Plus, we're breaking down the technicals that could signal a major turning point. You do not want to miss this. Let's get into it. First up, are we witnessing a seismic shift in institutional capital? Reports are flooding in about major players moving significant assets, and the destination might surprise you. This isn't just a minor adjustment, it's a potential redirection of billions that could reshape market dynamics as we know them. Get ready for the details on this massive strategic pivot that's already making waves across the industry. Then, we're cutting through the noise to bring you a crucial analysis of Bitcoin's core value proposition. Forget the day-to-day fluctuations for a moment and focus on what truly matters: scarcity. We're diving into the supply mechanics and on-chain data that paint a picture of long-term potential, even amidst short-term volatility. This is the kind of fundamental insight you need to understand where this asset is truly headed. Next, we're looking at how the big players in the corporate world are integrating digital assets into their strategies. Transparency, risk management, and governance are on everyone's minds, and we've got the latest on how major companies are handling their Bitcoin exposure. This is essential viewing for understanding the evolving corporate financial playbook. And finally, we're putting on our technical analysis hats to examine Bitcoin's current price action. Where are the critical support levels? What signals are flashing that could indicate a major reversal? We're breaking down the charts to give you a clear picture of the potential path forward. Don't go anywhere. Hit that like button, subscribe, and ring that notification bell so you never miss an update. Institutions flock to Ethereum, a major capital rotation. This story is crucial because it signals a significant potential shift in institutional investment strategies, moving capital from Bitcoin to Ethereum, which could have major implications for both cryptocurrencies. The crypto market is buzzing with activity as major players appear to be reallocating their digital asset portfolios, with a notable trend emerging: a significant movement of capital from Bitcoin towards Ethereum. This shift is not just a minor fluctuation. It represents a potential paradigm change in how large institutional investors view and invest in the cryptocurrency space. Recent data indicates that major entities are not only diversifying, but actively prioritizing Ethereum, driven by a confluence of factors including its growing ecosystem, technological advancements, and the increasing appeal of its financial products. One of the most talked about events involves a prominent Bitcoin whale holding over $5 billion in assets, who has been systematically divesting from Bitcoin to acquire Ethereum. This whale has reportedly moved approximately 2,000 BTC, valued at over $216 million, into hyperliquid and converted it into ETH. This is not an isolated incident. The same whale has previously transferred substantial amounts of Bitcoin to Ethereum, demonstrating a consistent strategy of rotating profits into altcoins perceived to have higher growth potential. This specific whale's activities have been directly linked to a 14% surge in Ethereum's price over the past month, underscoring the impact of large-scale capital movements on market dynamics. Adding to this narrative of institutional embrace, Ethereum spot ETFs in the United States have experienced a remarkable inflow of over $4 billion in August alone. This surge in ETF investments highlights a growing institutional confidence in Ethereum as a viable and attractive asset class. Furthermore, prominent firms within the crypto industry are actively expanding their Ethereum holdings. Bitmain, for example, recently bolstered its treasury by acquiring an additional 190,500 ETH, bringing its total holdings to an impressive 1.7 million ETH, currently valued at approximately $7.7 billion. Such strategic accumulation by established companies suggests a long-term bullish outlook on Ethereum's future. On the supply side, while the Ethereum validator exit queue has reached significant levels, with nearly $5 billion in ETH pending withdrawal, analysts are interpreting this not as a sign of distress, but as a reflection of healthy market demand and active participation. The extended withdrawal times, exceeding 18 days on average, are attributed by experts like Marcin Kazmierczak of Redstone to robust institutional demand that is more than capable of absorbing the available supply. This perspective suggests that the apparent increase in withdrawals is a natural consequence of a growing and maturing ecosystem, rather than a signal of investor capitulation. These combined factors, the strategic allocation by large whales, substantial ETF inflows, and the proactive accumulation by industry firms, collectively point towards a significant institutional pivot towards Ethereum. This trend underscores a broader diversification strategy among investors who are increasingly looking beyond Bitcoin to capture growth opportunities in the rapidly evolving blockchain landscape. The move signifies a growing recognition of Ethereum's utility, its technological advancements, and its potential for future appreciation. But is this capital rotation sustainable or just a temporary trend? Next, we'll explore the fundamental forces of scarcity that are underpinning Bitcoin's long-term value proposition. Bitcoin's scarcity, the foundation for long-term value. This analysis is vital as it cuts through short-term market noise to focus on Bitcoin's core attribute, its fixed supply, which is key to understanding its long-term investment potential. In the dynamic and often volatile world of cryptocurrencies, understanding the fundamental drivers of value is paramount. While Bitcoin, BTC, frequently experiences price swings that capture headlines, a deeper look into its on-chain data and supply mechanics reveals a compelling narrative of long-term scarcity-driven potential. This analysis moves beyond the immediate market sentiment to examine the underlying economic principles that support Bitcoin's enduring appeal as a digital asset and a store of value. The foundational principle underpinning Bitcoin's value proposition is its inherently limited supply. Capped at 21 million coins, Bitcoin is designed to be a deflationary asset, a stark contrast to traditional fiat currencies that can be printed at will by central banks. This scarcity is not merely a theoretical concept. It is embedded in the protocol itself through programmed halving events, which occur approximately every 4 years, reducing the rate at which new Bitcoins are created. The most recent halving, which took place in April 2024, further constrained new supply, intensifying the scarcity factor. As the network matures and adoption grows, this fixed supply becomes increasingly significant, potentially driving up the value of existing holdings as demand outstrips availability. On-chain analysis provides critical insights into how this scarcity is playing out in real time. Metrics such as the number of Bitcoins held on exchanges, the volume of transactions, and the behavior of long-term holders, often referred to as hodlers, offer a window into market sentiment and accumulation trends. Currently, data suggests a significant portion of Bitcoin's supply is being held by investors who are not actively trading, indicating a strong conviction in the asset's long-term prospects. The reduction in Bitcoin available on exchanges, coupled with consistent accumulation by long-term holders, creates upward pressure on price by limiting the readily available supply for purchase. Furthermore, Bitcoin's role as a potential hedge against inflation and economic uncertainty continues to resonate with a growing segment of investors, particularly institutions. In an environment where global economic stability is frequently questioned and inflation remains a concern, Bitcoin's finite supply positions it as a digital alternative to gold, often dubbed digital gold. This narrative is gaining traction, attracting capital from investors seeking to preserve wealth against the devaluation of traditional assets. The increasing adoption of Bitcoin by corporations and the development of regulated investment products like spot Bitcoin ETFs further validate its growing acceptance as a legitimate asset class. While short-term volatility is an undeniable characteristic of the cryptocurrency market, it is crucial to distinguish these price fluctuations from the underlying long-term trend. The scarcity model, combined with increasing adoption and network security, creates a robust framework for Bitcoin's potential appreciation. The halving events ensure that the rate of new supply entering the market continues to diminish, making each subsequent Bitcoin inherently rarer. This predictable, programmed scarcity is a powerful economic incentive that can drive significant value appreciation over time, especially as more capital seeks to enter the Bitcoin ecosystem. But how are major corporations managing their exposure to this volatile, yet potentially rewarding, asset? We will now delve into the critical aspects of corporate Bitcoin holdings and accounting transparency. Corporate Bitcoin exposure, navigating risk and transparency. This story matters because it addresses the growing trend of companies holding Bitcoin and the challenges they face in accounting for it, impacting investor trust and regulatory scrutiny. The increasing integration of Bitcoin into corporate treasuries presents both opportunities and significant challenges, particularly concerning accounting transparency and risk management. As more companies allocate capital to Bitcoin, they must navigate a complex financial and regulatory landscape, ensuring that their accounting practices are clear, compliant, and provide stakeholders with accurate information about their exposure to this volatile asset. Traditionally, companies have held assets like cash, bonds, and equities on their balance sheets. Bitcoin, however, introduces unique accounting considerations due to its nature as a digital asset, its price volatility, and the evolving regulatory environment. Under current U.S. Generally Accepted Accounting Principles, GAAP, Bitcoin is typically treated as an intangible asset. This classification means that companies must assess it for impairment. If the fair value of Bitcoin falls below its carrying value on the balance sheet, the company must recognize an impairment loss. Importantly, under current U.S. GAAP, these impairment losses cannot be reversed if the price of Bitcoin later recovers. This impairment rule has significant implications for companies holding substantial Bitcoin reserves. For instance, if a company purchased Bitcoin at $50,000 and its market value drops to $30,000, it must record a $20,000 impairment loss per Bitcoin. However, if the price subsequently rises back to $40,000 or even $60,000, the original impairment loss cannot be adjusted or reversed on the financial statements. This can lead to a disconnect between the asset's current market value and its book value, potentially distorting a company's financial picture and impacting key financial ratios. The lack of clear guidance on how to account for Bitcoin gains has also been a point of discussion. While impairment losses are recognized, reversals for gains are not permitted under current U.S. GAAP. This asymmetry can create a conservative bias in financial reporting, as companies may be more hesitant to report significant gains if they cannot be reflected on the balance sheet. The International Financial Reporting Standards, IFRS, however, offer more flexibility, allowing for revaluation of intangible assets if certain criteria are met, which can lead to a more dynamic reflection of Bitcoin's market value. Companies that have publicly disclosed significant Bitcoin holdings, such as MicroStrategy, have become case studies in managing this accounting complexity. MicroStrategy, a prolific buyer of Bitcoin, has frequently reported substantial impairment charges on its Bitcoin investments due to price volatility. Despite these charges, the company has maintained its strategy, citing the long-term growth potential of Bitcoin. Their approach highlights the strategic decision-making involved, where short-term accounting impacts are weighed against perceived long-term strategic benefits. Navigating these accounting rules requires robust internal controls and a clear understanding of the digital asset landscape. Companies are investing in specialized knowledge and systems to track their crypto holdings accurately and to comply with reporting requirements. The ongoing debate and potential future changes in accounting standards, particularly those being considered by the Financial Accounting Standards Board, FASB, could bring more clarity and flexibility, potentially aligning U.S. GAAP more closely with IFRS and allowing for a more accurate representation of Bitcoin's market value on corporate balance sheets. While accounting for Bitcoin is complex, understanding its price action is equally critical for investors. We're now turning our attention to the technical indicators that could signal a significant shift in Bitcoin's market trajectory. Bitcoin's critical support levels, charting a path to reversal. This analysis is essential for traders and investors looking to understand the key price points that could determine Bitcoin's short to medium-term direction and signal a potential trend reversal. Bitcoin's market has been characterized by significant volatility, making the identification of critical support levels crucial for navigating potential price movements and anticipating trend reversals. Technical analysis provides the tools to dissect price charts, identify patterns, and forecast future behavior based on historical data. For Bitcoin, understanding where strong buying interest is likely to emerge is key to managing risk and capitalizing on potential upward momentum. Currently, Bitcoin is trading within a range that has seen considerable consolidation. The primary support level to watch remains in the vicinity of the $60,000 to $62,000 zone. This area has acted as a significant psychological and technical barrier multiple times in recent trading sessions. Historically, when Bitcoin has approached this level, strong buying pressure has emerged, preventing deeper declines. The effectiveness of this support zone is critical. A sustained break below it could signal a more pronounced downward trend, potentially testing lower levels. Further down, a more robust support can be identified around the $55,000 to $58,000 range. This zone is underpinned by several factors, including previous significant price highs that have now flipped into support, as well as the 200-day moving average, MA, on several key trading charts. The 200-day MA is widely watched by institutional traders as a long-term trend indicator. If Bitcoin were to retest this lower support area, a bounce from this level would be crucial for maintaining a bullish outlook and confirming the potential for a reversal. Conversely, resistance levels are equally important. The immediate resistance sits around the $67,000 to $69,000 mark. Breaking decisively above this range, particularly with increased trading volume, would be a strong signal of renewed bullish momentum and could pave the way for Bitcoin to challenge its all-time highs. A sustained move above $70,000 would further solidify this bullish sentiment. On-chain data also provides context for these technical levels. Metrics related to exchange flows and holder behavior suggest that while some short-term holders might be liquidating during price dips, long-term holders remain largely committed, accumulating more Bitcoin at lower price points. This on-chain accumulation can provide a foundational support that complements the technical levels, indicating underlying demand that could absorb selling pressure. Risk management in this environment involves setting appropriate stop losses below key support levels and scaling into positions as Bitcoin demonstrates strength. For traders looking for a confirmation of a reversal, waiting for clear breaks above resistance levels or decisive bounces from strong support zones, accompanied by increasing volume, is advisable. The interplay between these technical indicators and on-chain activity will be critical in determining Bitcoin's next significant price move. We've covered institutional shifts, scarcity, corporate strategy, and technicals. Now, let's bring it all together with a quick recap and our call to action. And that's a wrap on another explosive episode of Bitcoin Bulletin. We saw major whales rotating billions into Ethereum, signaling a potential institutional shift. We dug into Bitcoin's scarcity driving long-term value, analyzed how corporations are navigating their Bitcoin exposure with transparency, and broke down the critical support levels that could spark a major reversal. If you found this information valuable, do yourself a favor and smash that like button, subscribe to Bitcoin Bulletin for all your essential crypto updates, and ring that notification bell so you're always the first to know. Don't forget to follow us on all social platforms for real-time insights. We'll see you in the next one.